Welcome, everyone, to another exciting week with our Mission Matters Club. This week's topic and discussion is: are we on the brink of a recession, and how to prepare for it and what to prepare for? And so every week we put together a dialogue with our podcasters, our podcast hosts, our authors, and our thought leaders that we work with. And so for those of you that are new or haven't heard of Mission Matters, since these conversations are recorded, Mission Matters is a mass media platform focused on the needs of entrepreneurs, executives, and experts. We hope to inspire and educate future generations. And the way that we do that is through our podcast content, our books, and all of the folks that we're able to aggregate together. And we work with an amazing group of thought leaders. And we'll have everyone here go around the room, introduce themselves. And so with that, why don't we maybe start from the top? And so Matt, why don't you kick it off?
Sure thing, Chirag. So, hi everyone, Matthew Cook here. I am the director of agency at Mission Matters. So, pretty much all things podcasts I am in charge of over at Mission Matters.
Awesome. Ken?
Hi, Ken Goldberg. I have a business that uses behavioral finance and crowd psychology to analyze markets and economies around the world.
Awesome. Dennis?
Hi, Denis Tan. I am a cost reduction consultant here, helping businesses find ways to reduce their daily operating expenses.
Awesome. JM?
Hi, I'm JM De Jesus, CEO of Quadrant 2 Public Relations, a corporate communications firm, and I also am a licensed realtor in the state of New Jersey. The economy is very interesting right now, and I'm studying it as carefully as I can, so you know that.
And last but not least, Scott.
Yeah, I'm a CEO and owner of Serving Strong Enterprises, a coaching and consulting company that I run and work with people in their 40s and 50s, preparing for their 60s and 70s. So the economy is very important to those who are planning for their fourth quarter.
Awesome. Okay, cool. Well, why don't we get kick-started? And maybe before we dive in, maybe let's just define it for those of you out there. But I guess, how would you classify, or what's the definition of a recession, I guess? Maybe let's start off with that, and then I guess dovetail that into, are we on the brink of one? Anyone want to take a stab at that?
I will, from my understanding of economics, it's at least 2 or 3 quarters of increased pricing in the market, and it seems like we're preparing for one. I'm not sure we're going to go headlong into it, but it seems like it. If all things that are information related are true, then yes, we could be. But again, I emphasize could be.
I'll just drop in. The Wall Street definition is 2 negative GDP quarters in a row. That defines a recession. So the question is, are we in one? And the answer is, according to Wall Street, we're going to find out in a quarter or so, because the data takes a while to get processed, and then it gets managed, manipulated, haircutted, and formed into what we're supposed to believe. But we just ended the first half of the year, and it's the worst first half of the year for the stock market, for the S&P 500 since 1972. So to put that in perspective, obviously, this is the worst first 6 months of a year since 50 years ago. And we all have lived through recessions in the past 50 years, none of which started out this bad. So to believe or discuss the potential that we're not in one is kind of head in the sand type of denial. We're in one. It just hasn't showed up on the nightly news because of the 2 negative quarter GDPs in a row definition. But yeah, we're in one.
And we know we've seen, the markets being impacted by this, but, with all of your businesses, I guess, how has it been impacting your guys' business in particular? Because I think we have folks in about 4 different industries here, actually. I guess 5, including Mission Matters, right?
Well, I'm lucky enough that recessions don't really bother my business, because when things are good, everybody believes they're geniuses in everything they do because everything goes up, right? And we've been in a bull market since 2009. Everything has gone up. That's actually not as good for my business of coaching and consulting on risk management and speculation management. So as things toughen up and people realize that they're maybe not quite as smart as they've been lucky enough to have been, I get busier, and it actually works pretty well for me. So I'm looking forward to the next couple of years as being pretty good.
I don't really notice a difference in clients whether or not they want coaching. What is a little concerning to me is on behalf of the clients who are, coming out of a semi-conservative portfolio, a recession might do for their retirement accounts and things like that, and how it impacts their daily lives, and how what they can do to prepare properly for it. And that's still up in the air as to what. I mean, you can move everything to a very conservative portfolio, but that's how I see it affecting my particular industry as a coach to people looking as into their future.
Do you think, Scott, and the rest of the panel, do you think we can benefit and profit from the volatility that's going on right now?
If you're willing to be, not you, but if people are willing to be open-minded and flexible, which are not two of the top traits that humans tend to exhibit or choose. We like rigidity and and uh, and closed-mindedness as a person. We don't like change. We like what's been working. But this is an interesting time in history, and I've studied it going back 300 years, so there aren't very many examples of times like this. So what are times like this? Well, we just finished a 40-year decline in interest rates. Interest rates peaked in 1979 or 80, and they bottomed in 2020. That's 40 years of declining interest rates and 2 years of rising interest rates. And just doing the math, it's impossible to equalize a 40-year decline in rates with a 2-year rise. So we're not done with rising rates. So rising rates are bad for bonds. And the last 40 years, when most people have entered the market, if you remember, previous to 1980, very few households had a significant portion of their net worth in the stock and bond market. Most of our net worth back then, and I don't mean us because I was too young, but most of the people back then had their net worth in their houses and their businesses. But not very many people had serious amounts of their net worth. And I think the number is something like 60 plus 65, 70%, something in the 60s percentage of the average American's net worth is in the stock market. So if we're going into a recession, and that's what such a horrible first 6 months of this year is forecasting, it's like the canary in the coal mine, and the canary's dead. So what's coming next? Everybody rushes out of the coal mine before the oxygen is used up. So that's what's been happening. Big money is getting out of the market. Hedge funds are going under and going broke. The whole crypto craze is blowing up literally every day. And at the same time that markets are dropping, that stock markets are dropping, interest rates are rising, which means bond prices are dropping. So there hasn't been very many times in the past 300 years that bond prices and stock prices have dropped at the same time. Normally, previous to 10 years ago, we used to think, well, we put together a balanced portfolio, and if my stocks went down, my bonds would go up. And if my stocks went up, my bonds would go down. So, as Scott mentioned, a conservative portfolio might be 70-30 stocks versus 30% bonds. But now it doesn't matter because stocks and bonds are falling at the same time. The bond market just had its worst 6 months in history. The stock market had its worst 6 months in 50 years. That's not good for conservative investors because nobody wants to really look at the data and the history of what could happen. And so the answer in my 35 years of helping and coaching investors and traders, most people say, well, as long as I keep up with everybody else, which in an environment like this for the next couple of years is kind of like keeping down with everybody else. If the markets fall 50% like they did in 2008 and 9 and like they did in 2001 and 2, then everyone's going to lose 50% of their portfolio value. And that's not okay, especially if you're in Scott's business of coaching people through their third quarter into their fourth quarter, a lot of these people, they can't sit through 10 or 15 years of net worth decline and until they get back up to anything that approaches the current level. So this is one of those rare instances where most people don't understand what a conservative stance would be. And in my opinion, from what I've studied and what I've learned, the only thing conservative about this type of scenario is getting your money out of the market and getting your money into cash and just sitting there and hope to a couple of years from now be able to purchase assets at 30 cents, 25 cents on the dollar. That's where the opportunity is, in my
Very
opinion.
interesting. Yeah.
So in that regards, I guess when is the right time to start, I guess, making those purchases, or how do you know if like when the bottom or like when's the absolute bottom, right? How do you know when you should start getting into the market, or how do you approach it? I guess is the question.
So, great question. In my 35 years, which has included working with some of the biggest investment banks in the world, trading on the floor of the CBOE in Chicago, having hedge funds, advising the government of South Australia, I've gotten the lowest price never. It's only by luck or complete lie does anyone get the lowest price. It's impossible to guess. There are conditions that you can look for that typically surround a price low. For instance, right now everyone's in the market. Everyone watches the market. Everyone's got their own market app on their phone. They talk about the market, and now everyone's saying, well, you know, the first 6 months was kind of bad, but I'm sticking to it because that's the only thing I know how to do. Okay, that's like I'm staying on the Titanic because I don't know how to swim. So what does the bottom look like? The bottom looks like nobody talking about the market, nobody looking to buy the dip, nobody interested in adding to their massively declining net worth and wealth. That's what's going to happen. The problem is people are so cross leveraged. People have borrowed exploding home equity and put money into the stocks and crypto market, and they've taken money out of their margin accounts and bought second homes or third homes or boats or cars they can't afford. So there's this not only consumer debt pyramid, but the government has $30 trillion in debt, and there's no chance, not one, impossible, that that's going to be paid back. That's an unpayable amount of money. The leadership by example has been horrible, and few people are old enough to remember the last time a situation like is possible. I'm not saying it's going to be happening, but it's possible that a situation like the 1930s could be in front of us. And there's no one alive that's lived through that. But if you can find someone, they don't describe it as a fun time. It was bad.
Cool. I appreciate your insights, Ken. I guess just to open it up, what industries do you think will do well during downturns in the economy? Which industries typically do well, and which ones I guess could be shorted or should people be getting out of?
Loan sharking does very well. Businesses that can work on barter might do okay. Businesses that are not leveraged may survive if you have a lot of cash. I mean, the things that work well in very, very tough economic times, the mafia did okay in the 30s. I don't know if that's something that we can all join. But things that people have to have, right? They have to have cigarettes, they like to drink alcohol, they got to eat. But, $100 a person restaurants in the next couple of years, not going to do very well.
And just curious because we haven't really survived a recession before, or I mean, I guess the last time we had a downturn in the economy, things like crypto or these alternative, I don't know if you call them alternative assets, but or like crypto or NFTs or some of these newer technologies didn't exist before. How do you think that's going to respond to this downturn?
Cryptos and NFTs and things of this nature are bull market manifestations of the crowd's mood. And the mood that we've been in is ebullience, mania, exuberance. Those are words that we've come to learn described about us by Federal Reserve chairmen and people like that who didn't really do very well in planning for the eventual downturn. I mean, up until about 2005 or so, there used to be this thing called the business cycle. We would go up for 2 years, and then we'd have a recession for 2 years, and then we'd go up for 2 years, and we would cycle. But we haven't had a recession in over a decade. The Fed has jammed the economy with so much money, believing, I'm not actually sure what they believe, but under the theory that if they just keep it afloat, maybe it would just fix itself, which clearly hasn't happened. When we're in a super mood, we'll believe anything. We'll believe crypto. We'll believe that altcoin Luna that 2 weeks ago fell 99% overnight. We'll believe Bitcoin, I think, just had its worst month ever in its history. I think Bitcoin's down 40% this month alone, and that's the biggest of all the cryptos. NFTs, kiss those goodbye. They're not going to be in the market for it. There's no liquidity. In order for those things to survive, think back into the tulip bulb mania. Tulip bulbs became the crypto of their day, but that was only until the bubble burst, and I mean the bubble of human mood, when it became obvious that the emperor had no clothes, that our shit really did stink. We didn't have stinkless poop. There was no market for tulips. There's currently no market for altcoins. There's no way Bitcoin has seen the low it's gonna see. People have been trying to buy the dip in Bitcoin from 70,000 all the way to today's 18,000 or whatever it went to. And Bitcoin and NASDAQ are now correlated at something like 0.99%, meaning they do what one does, the other one does. So if Bitcoin's leading the way, which it is, because it's kind of like the tip of our emotional risk-taking sphere, then the big cap tech stocks should follow, and the rest of the market should follow as well. There's not going to be any safe place. And we're about to come into second quarter earnings in 2 weeks. After the worst 6 months in the market's history, there's not going to be good earnings reports coming out in the middle of July. It's impossible. It's impossible. It could be a disaster. I don't want to be the doom and gloomer, but it's not my opinion. This is what history shows. So yeah, it's a time to be really careful, really, really careful.
Ken, I was going to ask you, what do you think that'll do to the real estate market?
The real estate market is no different than anything else. In fact, the US real estate market is not even close to the most speculative market in the world. Toronto, Montreal, the big Asian, Singapore, Shanghai, Sydney, New York. New York doesn't even place in the top 10, I don't think. But they're massively leveraged. I mean, how easy is it today to sell a $50 million condo in New York versus 2 years ago? 2 years ago, you couldn't keep them in stock. Now, prices are dropping all over the place. The guy in Bel Air with a $500 million house that he built on speculation 3 years ago just sold it at auction for 175 million, which is still a lot of money for one house, but he went bankrupt because the speculators just aren't doing it. And so real estate, it's going down. It's we can see the numbers. The numbers of new mortgage originations are plunging. Inventories have gone from 3 weeks to 3 months, and they're growing. Interest rates are skyrocketing. I just saw the number where from the 30-year mortgage going from 3% to 6%, 1/3 of the market that could afford a $400,000 house has been eliminated from the game. And that's a $400,000 house, which I don't know, that might be the US average, but if you live on East or West Coast, good luck finding a $400,000 house. So it's going to be bad. Sorry to say.
I was looking at the pending home sales last week, and that surprised. That went pretty much, people thought was through the roof, from -3.5 to like positive 1.75 in terms of sales. So I thought there might be some daylight still.
Now, and it hasn't really even started to get bad yet. We've had a couple months of kind of the interest rate shock, but the old school economists believe that when the government wants people to save money, they move interest rates high enough into the banks where people put the money in the bank, and then the banks are flush with cash, and then the banks can finance whatever needs to be financed. And when the government wants the public to do the financing, then they squish interest rates down, forcing us to take money out of the bank, which then creates all of our money available to go into the capital markets and buy stocks and fund corporate growth without the bank. Why have interest rates gone from 3 to 6% in 6 months, the fastest rise in the 30-year mortgage in history? Because banks are starting to price in the risk of default. Banks that barely survived 2008 without the government bailing them out can see what's coming down the road. And they raise interest rates to protect themselves. And not only are they raising interest rates, they're making the hurdle to get a loan harder. So you have to not just have income, you have to have income and assets. You have to prove where your assets came from. You have to, trace your funds. And it's just not like it was when, sign here, we'll check your assets later type of thing. So yeah, tough times.
I guess because we do get a lot of business owners that listen to this content and follow us. So I guess from the standpoint of a business owner, and maybe anyone else can take this too. I know Ken's an expert when it comes to just the economics and what's happening just from your years of experience in this. So would love your input as well. But as a business owner, I guess how do you prepare for these downturns, and what steps can you take to prepare for it?
After listening to Ken, I think I have to definitely agree with Ken because, coming from Singapore, originally from Singapore, even today, I still follow the news too. You got lots of people recently transacted property values at $30 million for an 8,000 square feet home. It's almost a weekly news that I keep hearing a new transaction that someone has that much money to buy a nice property. But, from a business standpoint, it all depends on how you take a look at your books, because for me I help businesses find ways to save money from their everyday and it's how prudent your bookkeeper or your accountant is, because ultimately, on a good year, if you're not looking at your books because you can afford it, that's great. But then when it comes to a time where you think you're going to be pretty tight in expenses pretty soon because of a plan, or you think a recession might be coming, it's time for businesses to take a look and say, hey, are we paying too much for what we are using? Do we need to cut? Should we be prudent in what we buy, what we spend, and things like that? And so they should really take a look at their everyday expenses, from simple things like the electric bill or the cell phone bill, anything like that, just to make sure they're not overspending on certain things. They may be a small amount of savings, but it all adds up at the end of the year. So yeah.
That's a great point, Dennis. If it were me, I would be slashing travel. Just because you can travel rather than Zoom doesn't mean you should at this point. I mean, just the price of travel, tickets are 3 times as much as they were a year ago. The best strategy that I'm giving to clients is that find your top 3 competitors and keep your eyes on them. Open up lines of credit and prepare to buy your competitors or their assets at pennies on the dollar. The fire sale is coming, and if you can last long enough to scoop that up, that could be the next 15 to 20 years of explosive growth for the survivors.
Actually, I think that's already happening, Ken. I mean, the baby boomers, COVID really hit really hard for those people who are in almost retirement age and are business owners. They have started selling their businesses to a younger age group in their 40s. And people around here in Wisconsin are seeing that, oh, okay, if you're able to own a business now at the age of 40 and buy over a business and run it, and they're seeing other opportunities in the area too. Competitors that also want to have an exit, they're seeing there's an opportunity to buy out that location because business is booming. But at the same time, while this is an opportunity for business to buy out another business through acquisition or merger or whatnot, the other thing they are struggling is finding the right workforce, because a labor shortage in this area. I think that the hardworking people in central Wisconsin here are on average working 2 jobs now because they see that, if someone's hiring and they want to offer that much, why not? I'll take it. They're working two shifts a day, and they're enjoying the amount of salary that they're getting because these people are realizing that a recession may be coming soon, and it's an opportunity for me to make as much money now and save up for the rainy days. But for the younger folks who just want an easy lifestyle, just to go to the everyday office, work, and come home, and it's one of those things where they haven't realized or struggled hardships. And if a recession were to hit, I think it's going to affect a lot of people, if nothing right is done correctly.
Yeah, I think so. Let's look at that. So people are now buying businesses from the older generation. I think that's what you're saying, that there's a lot of turnover in businesses now, but look at the valuation they're paying for the businesses. They're paying like stock market valuations, right? They're paying X amount times sales or whatever justification that the buyer can swallow in order for them to buy the business. With the buyer believing, the buyer of the new business believing, oh, well, look at the numbers that this business has done. So yeah, I'm okay paying, 3 times sales or something for it, whatever the valuation is. But if the economy turns down, and we have evidence that it has, the stock market discounts the economy by 6 to 12 months, and it just had the worst 6 months in history. So we know the economy's going to turn down. It's just a matter of time. There's never been a case that it's not happened. So if the economy didn't turn down with this horrible stock market performance, it would be the first time ever. And in my business, we deal with highly probable outcomes, and that's not a highly probable outcome. So people are buying businesses at peak valuation based upon the last trailing 12, 24, or 36 months of that business's business. And they're going to take over these businesses as the economy rolls over, and there's very, very difficult employee environment where you have to pay unbelievable amounts to get someone to come off their couch and go to work. So you see that the economy is going to turn down and the expenses are going to go up. And a lot of these people aren't buying these businesses for cash, so they're taking loans that they're not going to be able to potentially keep current, which means we all know what that means.
Yep, more government bailouts in the coming years.
Yeah, except not possible. We're at $30 trillion of debt. The government was bailing companies out as it was quantitatively easing and making money more available. Now it's taking money out of the system, it's making money less available, it's tightening, it's shrinking its balance sheet, it's raising its interest rates. Government bailouts, not going to happen. At least not in mass. There's no chance we could have a 2008 bailout anymore. I mean, look, if at some point foreigners that buy our debt are going to realize there's no chance they're going to get paid back, which means that they're going to demand from the US government higher interest rates, which is why the long end of the curve is rising. And right now, if I can remember correctly, I think the 10-year yield is about just dipped under 3%. So the 30-year yield is probably 3.25%. And foreigners are going to come to our auctions and say, well, yeah, we'll buy your debt, but we're not going to pay 3%. We're going to need 6 or 7%. And the US interest rates are going to skyrocket. And the mortgage rates are going to skyrocket. 6% in a 30-year mortgage, that's not the highest it's going to get. We're going to see double-digit mortgages. We're going to see a 10% 30-year mortgage in the next 3 to 5 years because of the demand for money. People will pay anything for interest if they can get the cash to try and stay afloat. Worst case scenario is if they can't stay afloat, they'll declare bankruptcy. They'll hope for a bailout. If that doesn't work, they'll declare bankruptcy.
But interest rates were 16, 17% at one point. So for them to go to 8, 10%, wow, that's terrible. It's not that terrible. It's been more terrible.
Yeah, but look, what was the average price of a home when interest rates were 16, 17%? Homes were $35,000, $40,000. Now they're, you know, even though the average is lower, people are buying $1 million houses, and then they're buying second $1 million houses because they think they can currently cash flow them in the big cities, at $5,000 a month Airbnb fees and things like that. So yeah, it's not just a dollar for dollar comparison of, well, you know, we did 6 or 8% mortgages before, we could probably survive that now. No way can this population survive 8 and 10% mortgages. It's collapsing at 6.
I'm glad you brought that up, Ken, because I'm out in Scottsdale, Arizona, to where during COVID, a lot of people ended up moving here. The market, in terms of housing, increased exponentially. I mean, houses went from 250,000 to all of a sudden $1 million. So you've had this crazy rise in terms of the prices. And to find out, a lot of that money that was coming in were from investment firms, hedge funds, and then places like Airbnb, which Airbnb was one of the largest purchasers of homes here in Arizona, the company itself. So they decided that they're going to go out and start actually buying properties, manage them, rent them out. Now, I've already seen multiple Airbnb properties that they had bought, and they're actually trying to offload it, even though they have a year worth of income coming in off of that property. So it's just kind of a sign that everything is starting to shift and change. I actually just had a friend who just purchased a house that he was selling his home because of the standpoint that a hedge fund, or might not have been a hedge fund, but a financial firm was coming in doing a 1031 exchange. And they were paying over the asking price and cash for it, and they ended up pulling right at the last second. And this was only, gosh, within the past month or two that this took place. And now we're starting to see it all over the place. The deals that were in place are all of a sudden the investment firms are pulling out of them and no longer paying that top dollar. And you're starting to see these home prices start to come down, and some of them are coming down significantly that were priced in the 8 to 10 to $15 million range. They're coming down already to where they're $5 million, and this is occurring over the course of 30 to 60 days. So it is pretty enlightening to see that dynamic take place, and everything you're saying, I'm seeing it in real time out here in Arizona.
Yeah, and if you've tracked the price of Airbnb and Zillow, I mean, Zillow 5 years ago decided that rather than just create data for other people, that they were going to do the same thing. They were going to flip houses. They loaded up on massive inventory of houses, and Zillow stock is down 75, 80%. Airbnb has gotten crushed. They should have been minding their business, but they got greedy. The ebullience, the exuberance, the mood thrust, this high captured everybody. And now it's time to pay the piper. We need to cleanse, just like the previous business cycles were 2 years up, and we cleanse it out in the next 2 years, and then we start again. We haven't had the cleansing in 12 years. 2009 was the bottom. Well, we got some cleansing done between '07 and '09, but we haven't had any cleansing since. You could argue, well, maybe 2015, 16, okay, maybe. But serious cleansing, look at like you were saying, I mean, Matt, you just described, yeah, here in Arizona, yeah, like 8 and 10 and $12 million houses are now all the way down to 5. 8, 10, and $12 million houses are really expensive. I mean, I live in Seattle. There's expensive houses all over the place, but we talk about these multi-million-dollar houses like it's just not not extraordinary. Like, oh yeah, yeah,
Well, what was crazy to me is seeing that the majority of people that are buying houses right now are paying between, and these are average income individuals that are buying $750,000 to $1.25 million houses and thinking that's completely normal. I mean, and these are average income. I mean, middle America. Like, I couldn't fathom when I'm hearing this that around, oh yeah, I'm buying $1 million home, and it's like, hang on a second, like, take a step back. This home was worth literally 2 years ago $250,000,
yeah.
and
And
so that is where that right there is terrifying to me.
it is, and you brought up a good point when you said that because of COVID, right? What happened with COVID? They flew out of the big cities. San Francisco had an exodus. New York's population went to Miami. Everyone on the West Coast left San Francisco and went to Arizona and Seattle. So the fair value, let's talk about it that way. The fair value of an Arizona house before COVID, let's say it was 350,000, and let's say the fair value maybe should have gone to 550,000, just because so many people were going there. But then the hype came in and hedge funds turned on and people were buying houses with exploding home equity. And now houses have gone to a premium to value, overvalued. So the first thing houses have to do, and stocks, is at least come back towards fair value. And we know how that works. A pendulum doesn't swing from left to right and then stop in the middle and go back up to the right. A pendulum swings from all the way at the right to all the way at the left, and then it goes back all the way at the right. So if houses have gone from 250 to 300 to a million when they should have stopped at 600,000, they're not going to just come down to 600,000. They're going to go below that. They might go to 450, they might go to 375. But, if we look at this, concept of regression towards the mean, that works with data points. But when you're the guy trying to sell your house in middle of 2023 after a full year of acknowledged recession, and good luck trying to get what you think is fair value. It's just not going to happen. So that's why, and hedge funds are going to absolutely take it in the teeth. The hedge funds are going to be dumping houses faster than Zillow and Airbnb. There's going to be a massive supply of formerly outrageously priced assets that are going to come to the market at whatever the market will bear. And if the market isn't bearing very much, it's going to be some cheap stuff. So keep your eyes on your favorite house. It's coming your way.
Oh, I've got my eye. I've got my eye on one in particular. I'm like, oh, this is going to come right down into my price point. So I'm in line with you, Ken, on that. I've kind of, not to toot my own horn here, but I've been calling this since really the beginning, of 2020, because of the standpoint that I was out here in Arizona when everything was on the rise previously, right before 2008. So at that time, I was out here just getting into my professional careers and so forth. And when I saw that, and I happened to be in finance at the time, all of a sudden I'm seeing a lot of the same same kind of feel to it. And I've just said, I'm like, this market is not going to last. We are going to come, and it's going to be that hard shift that you said, Ken. That pendulum is going to shift hard, and it's going to go way past the point of where the value should be with those increases, like you said, and it's going to go way below. So I've got my eyes on a few things, and actually kind of, I wouldn't say looking forward to this, because obviously it's going to be a challenge for everybody. But one of the things that I've noticed too in that time is that when there are downturns, when there are recessions, it's a great opportunity for the businesses that can separate themselves from the others and from the crowd, that ultimately end up making it through and doing well because of it.
Yeah, no doubt. Good for you. It's a great plan.
Absolutely. I mean, there's so many golden nuggets here. So usually we try to keep these conversations to about like an hour. And so wanted to just kind of see, as we're wrapping this up, wanted to see if anyone had some final points, thoughts, ideas, or tips or tricks or anything that they would like to share, or insights on just this topic before we do a final closeout. If anyone want to share any last words or has any final questions.
Ultimately, the advice you give to people right now is to keep cash. Cash is king. So the amount of money you can save, great. The amount of money you have in your bank, keep it safe for the rainy days, and just be cautious on your expenditure or spending in general.
Cool. Any last takers?
Great advice, folks. Thank you for sharing.
Awesome. Well, cool. I guess with that, we have our next week's conversation already teed up. It's going to be on which industries are basically going to be evaporating. So it kind of this is like a follow up to this conversation. So we'd love to have all of you guys join, and any others that are out there that listen into this recording. Again, our next conversation is every Thursday, 4 p.m. PST. So we keep it consistent. Other than that, thank you everyone for joining here, and for all those tuning in. I hope you have a great evening.
Thank you, everybody.